Most people open fintech apps without thinking twice. They check their balance, move money, invest spare cash, or pay bills in seconds. No branches, no paperwork, no waiting lines, just instant access to their financial life. It feels safe because it feels normal. But that's exactly where the real question starts. Because modern fintech apps are not traditional banks. They are digital platforms built on top of banks, cloud systems, APIs, and third-party infrastructure. And that means your money is not sitting in one simple place the way most people imagine. So the real question is not whether fintech apps are safe or unsafe. The real question is how they are structured, who actually holds your money, and what protections are really in place when something goes wrong. And if this breakdown helps you understand money and security more clearly, subscribe to the channel. We break down real financial systems every week in a simple way that actually makes sense in the real world. Now let's get into it. How fintech apps actually work behind the scenes. The biggest misconception about fintech apps is that they directly function like a bank. In reality, most fintech companies are not banks at all. They are technology layers that sit on top of regulated financial institutions. When you deposit money into a fintech app, it is usually transferred to a partner bank that actually holds the funds. The fintech platform simply acts as the interface you interact with. So what you see on your screen is not where your money physically sits. Think of it like this. The fintech app is the dashboard, but the bank is the vault. This structure is what allows fintech companies to offer fast onboarding, instant transfers, clean user interfaces, and automation features without holding a banking license themselves. But it also means your money depends on multiple systems working together correctly, not just one institution. Is your money actually insured? One of the strongest protections in modern fintech systems is deposit insurance through partner banks. In many regulated financial systems, deposits held at partner banks are insured up to a fixed limit per depositor per bank. This means that even if a bank fails, your eligible funds are protected up to that limit. Some fintech platforms also use something called sweep networks, which distribute your money across multiple partner banks. This can increase total insurance coverage far beyond the standard limit. However, this protection only applies to specific types of accounts. Cash deposits in insured accounts are treated very differently from money invested in stocks, crypto, or other financial instruments. Investments are exposed to market risk, not insured protection. So when people ask if fintech apps are safe, they are often mixing two completely different systems: insured deposits and market-based investing. Understanding that difference is critical. Why fintech feels risky even when it is secure, even when the underlying systems are safe, fintech still feels uncertain to many people. That is usually because of visibility, not actual danger. With traditional banks, people feel security because they can physically see branches, speak to staff, and rely on long-standing institutions. With fintech apps, everything is digital. There is no physical presence, no visible vault, no face-to-face reassurance. That lack of physical structure creates psychological uncertainty. But in reality, most fintech platforms operate with modern security systems that are comparable to or even more advanced than traditional banking systems in certain areas. The difference is not necessarily safety. The difference is perception. People naturally trust what feels familiar, even when newer systems may be equally secure or more efficient. As digital finance becomes more common, that psychological gap will likely continue shrinking. Over time, trust is built through repeated experience, reliability, and convenience, which is why fintech adoption continues growing despite early skepticism from many users. The real security risks in fintech apps. When people think about fintech risks, they usually imagine hackers breaking into systems and stealing money. But in practice, large-scale system breaches are not the most common issue. The most frequent risks come from access, behavior, and system design. One of the biggest risks is account compromise through stolen credentials. If someone gains access to your email or password, they may be able to reset accounts and access financial apps. Another major risk is phishing attacks. Fake emails, websites, or messages trick users into voluntarily entering login details into fraudulent systems. There is also platform dependency risk. If a fintech company experiences downtime, technical failures, or operational disruptions, users may temporarily lose access even though their funds are still safe in underlying accounts. Finally, there is integration risk. Fintech platforms rely heavily on third-party services such as payment processors, identity verification systems, and cloud infrastructure. If one of these layers is compromised, it can create ripple effects. So the real risk is not one single threat. It is the combination of multiple interconnected systems. How fintech apps protect your data despite concerns. Fintech companies invest heavily in security infrastructure. Encryption is one of the core protections. It ensures that financial data is protected both when stored and when transmitted between systems. Authentication systems such as multi-factor verification add extra layers of identity confirmation beyond just passwords. Token-based systems replace sensitive financial data with secure placeholders during transactions, reducing exposure of actual account details. On top of that, fraud detection systems continuously monitor activity patterns in real time. If unusual behavior is detected, systems may automatically flag or block transactions. These protections are designed to work together rather than rely on a single barrier. That layered structure is what makes modern fintech security resilient. Fintech versus traditional banks. The real difference: traditional banks and fintech platforms are often compared as if they are completely separate systems. But in reality, they are deeply connected. Most fintech companies rely on licensed banks to actually hold customer funds. The fintech layer simply provides the interface, automation, and user experience. Traditional banks, on the other hand, manage both the infrastructure and the customer relationship directly. This creates some important differences. Fintech platforms are faster, more flexible, and easier to use. They are designed for digital-first users and modern financial workflows. Traditional banks offer physical branches, broader legacy services, and long-established regulatory history. Both systems can be safe, but they serve different purposes and different user expectations. The key difference is not safety. It is structure. Why bank failures change the conversation. Events like major bank failures have shown that no financial system is completely immune to risk. Even large, established institutions can face liquidity issues or collapse under extreme conditions. When that happens, depositors often rush to understand where their money actually is and how it is protected. These situations highlight an important truth. The safety of money is not just about the brand name of a bank or fintech company. It is about how the system is structured, how deposits are distributed, and what regulatory protections are in place. Fintech platforms that partner with multiple banks or use distributed deposit systems can sometimes even reduce concentration risk compared to traditional single-bank models. But again, structure matters more than branding. How to actually stay safe using fintech app security is not only about the platform. It is also about how you use it. One of the most important steps is enabling multi-factor authentication. This ensures that even if your password is compromised, access is still blocked without additional verification. Using unique passwords for financial accounts reduces the risk of cross-platform breaches. Avoid clicking unknown links or responding to unexpected login requests, especially those claiming urgency. Regularly checking account activity and connected devices can help detect unauthorized access early. And finally, keeping funds diversified across reputable institutions reduces exposure to any single platform or system failure. These are simple habits, but they significantly improve real-world financial safety. The real answer to the question: so, is your money safe in fintech apps? The honest answer is yes, but with conditions. In regulated environments, fintech apps that partner with licensed banks generally provide strong protection for deposits. Security systems are modern, layered, and continuously monitored. However, safety is not absolute. It depends on what type of financial product you are using, how your funds are structured, and how you manage your own account security. Cash deposits in insured accounts are fundamentally different from investment products exposed to market risk. And access security depends as much on user behavior as it does on platform design. So the real takeaway is not fear or blind trust. It is understanding. Fintech apps are not fragile systems waiting to fail. And they are not magical vaults that eliminate all risk either. They are layered financial ecosystems built on top of regulated banking infrastructure, enhanced with modern digital security, and shaped by user behavior. Most risks do not come from dramatic system failures. They come from misunderstanding how the system actually works. Once you understand where your money sits, how it is protected, and what role each layer plays, the entire system becomes much clearer. And clarity is what actually creates financial confidence in a digital world. If this breakdown helped you understand how fintech security really works beyond the surface level, subscribe to the channel. We break down real financial systems every week in a simple, practical way so you can make smarter decisions in a digital economy. And if you know someone who uses fintech apps every day without really understanding how they work, send this to them. It might help them see the system more clearly and avoid confusion that most people never question. Because in modern finance, understanding the system is the real foundation of safety.